Number 2. Yeah, let's have a think about number 2. And it's all about the wording of the question. We've got some land, which is PPE, and has suffered an impairment loss. Now, with impairment, there is no choice. You must write the asset down, so the carrying value is 15. No debate, no argument. Yeah, the carrying value must be fairly crisp and certain. With an impairment loss, it's a non-cash expense. With an impairment loss, you are not going to get immediate tax relief. It will be disallowed. So therefore, the taxman ignores the impairment loss, and therefore the tax base remains at 20. If you have a revaluation gain, it is taxable and there is a liability. If you have a loss, it's deductible and we are creating a deferred tax asset. So this is a deductible temporary difference and will create a deferred tax asset. And these are the 2 classics. These are the 2 building blocks. These are the 2 that you effectively have to know. And then if you've got these principles, we can start to apply it in other situations. Number 3. If it costs 100 and you've depreciated it by 15, then the carrying value is 85. No doubt about it. For taxation purposes, depreciation is disallowed. It's a non-cash expense. It's an estimate. You don't get immediate tax relief on depreciation. The taxman has their own rules. Tax depreciation, capital allowances, call it what you will. So the tax relief granted by the government is more generous at the beginning. So we have here a tax base of 60. The carrying value of our asset exceeds the tax base, so that is a taxable temporary difference. We've got a cash flow advantage. We're paying less tax because we've got accelerated capital allowances. We're deferring the payment of tax. It's a taxable temporary difference. Again, a good classic example. Simple example. Yeah? Is that okay? Going. Number 4. Current assets include interest receivable of 1,000. So let's think about what that means. I have earned interest, but I haven't received it. So I have credited my P&L, not because I have received the cash, but because I am debiting my asset. So I have here a carrying value of 1,000 in my asset because I haven't received the cash. Under local tax rules, it's only taxed when it's received. What's the tax base going to be? Yeah, the tax base is going to be nil. The taxman is ignoring it. So we don't get a current tax assessment on it. It's ignored. The tax base is nil. We will pay tax in the future when we receive the money. But I want the taxation charge this year, so I'll account for the deferred tax liability and the expense. So I have a taxable temporary difference of 1,000. Bish bosh. I'm happy. Number 5. Trade debtors are 10. That's what he said. Debited debtor, credited revenue. This revenue has already been included in taxable profit. Well, if the revenue's already been included in taxable profit, the taxman is already acknowledging and taxing the revenue and acknowledging the carrying value, the tax base of the asset. So what's the tax base going to be? Correct. arguably not everything in the balance sheet is a temporary difference. Yeah? So sometimes if you make a profit, you are taxed on it in the current year, and therefore on that basis no deferred tax arises. So, yeah, that's a sort of trick. Yeah, but ultimately I think that's logical. Number 6. I say 2. Inventory is valued at the lower of cost and net realisable value. So we've written it down to an NRV of 4.5. The carrying value must be 4.5. Local tax rules, no tax relief. Local tax rules suggest that write-down is notional, that write-down is non-cash, that write-down will not be given immediate tax relief. So the implication is that the taxman is ignoring that write-down. What's the tax base? 5. Difference is 500. Taxable or deductible? Deductible. Yeah, correct. Yeah, we're getting into a rhythm. It's a bit like cash flow yesterday. All seems a bit strange at the beginning, but it's a repetitive process. Right. Number 7 and number 8 could accidentally catch you out. These are both liabilities. Now, when we are listing liabilities in a list against assets, there's a very strong convention that assets are positive and liabilities are negative. So the assets are the debits and the liabilities are the credits. So if I'm to get this the right way round in terms of taxable and deductible, I just need in the first place to have my liabilities in brackets as a routine. I mean, conceptually we can understand it, but conceptually I will explain it. So for number 7, the liabilities has a carrying value of 1,000 because it says current liabilities include a provision of 1,000. So the carrying value is 1,000. I have debited the P&L and I've credited a provision. So there's a valid expectation, there's a constructive obligation, whatever. This is deductible for tax on a cash basis. In other words, we haven't yet paid the cash. The provision is there because we haven't paid it. So for taxation purposes, they're only going to give us tax relief when we do pay it. Maybe this is, what's the tax base? Correct. Tax base is 0. Tax base is nil. We're going to get tax relief in the future. We're going to get, this is a deductible temporary difference. The loss, the expense, has not yet been acknowledged by the taxman. So the liability is representing the loss, the expense, which has not yet been acknowledged. So this 1,000 here is deductible. This 1,000 here is deductible. Minus 1,000, nil, is minus 1,000. Now, well, from a mechanical basis you can work it out, but conceptually you can also work it out. All of these are temporary differences. Temporary. Because when you pay the provision, both will become nil. When you sell the stock, both will become nil. Ultimately, everything becomes nil. When you sell the land, it becomes nil. Yeah? When you write off the asset, it both become nil. When the asset disappears, then the carrying value is nil and the tax base is nil. Number 8. Current liabilities are 5. and the related expense has been deducted for tax purposes. I've charged 5 against profit, and I've set up a liability of 5. But the taxman has already deducted that expense. So the taxman has acknowledged the existence of the expense, and therefore, logically speaking, has acknowledged the existence of the liability. And on that basis, the tax base is 5. So there is a difference in the language that is going on. Yeah? So, boring stuff now, unnecessary stuff now, but let me do it anyway. 10,000 minus 5,000 plus 25,000 plus 1,000 minus 1,500, 29,500. So you've got a net taxable temporary difference at the year end. So we would take 29,500, we would multiply by the tax rate is 30%, and then that would give you a number, which is 8,850, and that is your deferred tax, that is your liability, that is your deferred tax, that is a non-current liability. This approach facilitates me going through 8 examples very quickly. Realistically though, in the exam, you are more likely to have to write each of them out. And the question could be about impairment or provisions, or PPE or revaluations, and then as a little add-on, oh, by the way, what's the deferred tax implication of what you've just done? Almost finished with deferred tax, but not quite. You will notice that I have netted off the two. That where we've got a taxable temporary difference and a deductible temporary difference, I have netted off the two. And this implies 2 things. First of all, you're legally entitled to do that. And secondly, you're in the same country. You see, if FTMS has a deferred tax liability in Malaysia, but FTMS has a deferred tax asset in Singapore, the Malaysian government and the Singapore government are different, so you would therefore have both a deferred tax liability and a deferred tax asset. So the fact that they are netted off implies 2 things. First of all, that you're legally entitled to, and secondly, it's in the same country. And both of those are reasonable assumptions unless you are told otherwise. Yeah? So they are netted off. 1, because it is legally permissible to do so. And 2, that these balances and transactions are in the same country, so you owe the tax to the same tax authority. Right, time out for a sec. Tax rate is 30%. Tax rate is 30%. There's only one rate given, so that's the rate that we used. Conceptually though, is that the current rate or the future rate? In some countries, in some situations, you may be paying tax on current profits at 30%, but you may know already that next year you'll pay tax at 25%.